Austin, good to see you. Today we get to talk about how to minimize capital gains tax. So we're going to talk through four strategies that range from timing to charitable giving to certain investment techniques. So let's start by explaining though when you are on the hook to pay capital gains tax. What do we need to know?
Yeah, this can be a bit tricky, I think, and for some folks, a little bit confusing. But if we have, for instance, a taxable brokerage account, one that does accrue these gains over time, really, we're not on the hook to pay this capital gains tax until we actually liquidate the security and realize the capital gains. So once we
Mhm.
sell any security that has a gain and realize it, that is when we're on the hook, and Uncle Sam will come knocking for that tax bill.
As he does. All right, so now let's talk through those strategies then to minimize the taxes. The first, bite the bullet now, pay those taxes now, considering we are living in a historically low tax period.
Yeah, this one doesn't sound too exciting, Aaron, but really for many folks, this can be the right and correct move. And really, it's based on a few different situations. Number one being, again, we are in a historically low tax rate environment. And depending on your unique situation, if we have a lower income year, perhaps we just changed jobs and maybe took a pay cut, it could be an advantageous time to take advantage of realizing some gains in those lower income years.
Okay. And next you could consider something that is known as a donor advised fund.
Yeah, this is, Aaron, a really nice way to kind of kill two birds with one stone, if you will. But simply you, as the donor, can give either cash or securities to a fund, being an investment account, and then you receive in that current year that you give the contribution a current year tax deduction, and you also get to direct where and when these funds go to each charity. So it could be one charity or multiple charities. So really, it's a way that we can not only accomplish our goal of charitable giving, but also receive some tax benefits in the process.
Interesting. And the next strategy is known as tax loss harvesting.
One of my favorites here. Really a pretty simple strategy here when we break it down. But essentially, we want to offset our winning securities with some of our losers. So we on purpose realize and sell some securities that are at a loss to offset some of those positions that are at a gain, thereby harvesting those losses and being able to utilize them to offset the gains and thereby reducing our tax liability.
I can see why that is an attractive option. And then last, you say you need to make sure that you hold that asset for more than a year. Why?
Really, really simple here. If we hold an asset for more than a year and then realize that gain, it is taxed as a long-term capital gain. If we do not hold the security for more than a year, then it will be taxed as a short-term capital gain if we sell it, which that tax rate is at your ordinary income rate, which depending on your income level, that could be much higher tax rate on that sale. So we just want to be mindful of that. It's something really simple just by kind of paying a bit more attention and knowing those differences can potentially save us some significant tax liability.
It's nice to know that we have some options and some strategies when it comes to saving money on those taxes. Austin, if somebody would like to talk this through with you, what's the best way to reach you?
Yeah, you can give us a call at 919-322-4113 or shoot us an email at info@patriotwealthnc.com.
Great. Austin, thank you.
Thanks.